Last week in the S&P 500, we saw the market continue to climb to all-time highs for the 6th week in a row, and when we take a look at it on an overall forward P basis, it does look to be severely overvalued in pretty much every single industry. Now, there is one company that we believe to be undervalued, that is Amazon, and we believe it deserves some serious attention, and in fact they are reporting their earnings in just a few days. Now, we notice Wall Street gives this a strong buy, also seeking alpha with a very healthy buy at 4.23 out of 5, and we can see Quant, although it is a hold, 3.47, they need a 3.5 to be a buy, so they're not too far off, this also being a company they consider to be undervalued. Now, we believe this have some serious consideration in every investor's portfolio. We want to explain why in today's episode, run through metrics, and also take a look at our own valuation. Now, first things first, how did they perform in the previous quarter? And we can in fact see they did miss on the revenue, although marginally, and the guidance for the next quarter wasn't what the market wanted to see. Now, what did those numbers reflect? Well, as we can see, the EPS was a very strong beat, 1.26 versus 1.03. The revenue, although a miss, we do notice it was marginal, 147.98. As we can see, market wanted 148.56. Now, the market also for Amazon, similar to Alphabet that we reviewed a few days ago, have certain metrics that they keep a close eye on. AWS, well, that was a nice beat by 300 million. However, the advertising wasn't what the market wanted to see. It came in 200 million under the 13 billion. As we showed earlier, companies are now trading at a premium, so the market at a bare minimum wants to see a beat, although on an ideal scenario, they'd also need to increase that forward guidance. We also note that the quarter that is approaching for Amazon, they are anticipating around 8 to 11% growth, and we can in fact see that is trailing the analyst estimates of around 158.24 billion. So some things to consider with Amazon in terms of both bullish and bearish scenarios, and we also have one here which effectively talks about competition in this market. There are lots of large discount sites. We have Temu, we have Shine as well, and this effectively allows US customers to maybe move away from Amazon and start buying from Chinese merchants. But again, there are some different considerations with this aspect as well. Now, something that maybe does go under the radar with Amazon, one, the way they are improving their margins, looking towards the future, is they are doing a lot of investment in robotics to effectively bring down a lot of their operating costs. And as we can see here, although this article is from a few months ago, Amazon is continuing to invest a large sum of money into the supply chain and the logistics, so effectively they can make costs a lot cheaper and in turn pass that on to the consumer, which will move them away from looking at further discounted sites like the Chinese comparisons that we did mention earlier. What's also interesting to note for those that want a little bit more into the background of robotics, there are different ways that they are trying to lower their costs. As we can see, they have some very funky names for their robots. Each one has their own purpose, and definitely something to go check out if this is an area that does interest you. Regardless, the whole point of this, the bottom line is that they are trying to make this company more profitable and in turn pass off some of those cost savings to the direct consumers. Now, before we look at any more information, let's just have a recap of how this company has done. Over the last 12 months, they're up 48%. Over the last 10 years, massive outperformance of the S&P, up 1,217%. And whilst we appreciate this doesn't pay a dividend, you could argue that total return is absolutely phenomenal and you probably wouldn't be too fussed at this point in time. But it'll be interesting to see, as we've seen with other companies like Meta, like Alphabet, who have recently started to pay out dividends, whether or not Amazon over the next few quarters will follow suit. We also note they are a little bit away from their 52-week high, but we wouldn't be surprised to see them break out to new all-time highs in 2024. Forward P, we're going to cover that shortly, as we can see here, below 40. And as we've already mentioned, the market does believe Amazon is in a golden opportunity today. Now, a few things that we've uncovered from their latest investor presentation. These are all based on a trailing 12-month basis, and we can see their top line continues to tick higher and higher. In fact, from the latest quarter, it is up double digits, 12% on a year-on-year basis, and we can see the split here looking very healthy for this company, and we do anticipate this double-digit growth to continue for the foreseeable future. In terms of their operating income and why we highlighted the robotics earlier, we believe their bottom line, their operating income as well, is going to really benefit from lowering those costs. We can already see it's up 207% on a year-on-year basis, something that we do believe will continue. We then take a look at their bottom line net income, as we can see also up triple digits at 240%. And remember, the more profitable the company is, the more ways that the company can return a lot of that excess cash to investors, whether that's through a dividend, whether that's essentially through share buybacks, or in fact, if it's putting that money back into the company, more innovation to lower their overall costs, and in turn the share price will increase like we've seen with this company. We then also take a look at free cash flow, very, very important, as this will take part in our valuation model. We can see up 572% on a year-on-year basis, something that they do believe will continue over the next few years and beyond. And as we said, with robotics lowering the cost in this company, this is one of those that could really, really benefit as an overall point. In terms of their shares, this is one thing where we have to say that it's not the greatest. We ideally want to see their share count reduce, as we will show you over the last few years. And in fact, as we can see from this graph, it has increased. Maybe marginal is one thing you could argue, but again, just something we would ideally like to see if they do have a significant amount of cash, which we will come to analyze. Now, continuing the theme on essentially looking at their metrics, free cash flow per share, what we want to see here is consistent increases over the longer term, and we actually get that. Although there was a hiccup in 21-22, they have been investing a lot of money into R&D, and as we said, we do believe this will, over the next few years, really benefit the shareholders. Over the next 12 months, it is expected to nearly double, and this is important because when we do come to our own valuation, you will understand where we've effectively got a lot of the numbers behind them. Sales growth, we can see nearly double-digit increases to the top line every single year, but again, one thing we do need to consider, not everything is bullish. We also need to look at the flip side, and some bearish indicators are that the Chinese companies, as well as other competitors, continue to lower the cost of their products, moving consumers away from Amazon. But as we saw, it isn't just a retail business, there are other parts to Amazon as well. In terms of a numerical perspective, we can see some very large growth over the last 10 years, going from 90 billion to 575. That is more than 6 times growth over the period. And we also already flagged this just minutes ago. Shares outstanding has been increasing. They have been diluting your position as a shareholder if you did buy in 2014, or in fact in any point over the last 10, that you wouldn't really care. We've seen the share price, it has grown substantially over the last 10. ROIC, now we want 10% or more. Give us faith, management are able to effectively allocate their capital. Not something we see on a consistent basis. Hopefully moving forwards, they can continue this minimum level of 10% that we saw in 23. Trading 12-month basis at 14% is also very nice to note. One reason why we keep badgering on about increasing their margins is because ultimately we see it is very low. Ideally, we want minimum 12%. One thing that we do have to commend here is that they have been doing operating efficiencies. Margins have been increasing over the longer term, 9% on a trailing 12-month basis, and I do believe over the next few years, we will start to see these margins further improve, and that is effectively what we want to see. Free cash flow margin, minimum 5%, which is what we see there or thereabouts. It isn't a company that actually has very large margins, but one thing we do note, their free cash flows year on year are very, very high, and they do look to be increasing, as we can in fact see up 572% on a year-on-year basis. Then we get to the final metric for this part of the analysis, the net debt to EBITDA. EBITDA referring to the earnings before interest, tax, depreciation, amortization. Below 3 is what we want to see. 0.61 in 2023. What this flags are the number of years it would take the company to pay off all of their debt net of cash on hand, correlates to the balance sheet strength, and we notice very low at 0.61, 0.43 over the next 12 months. So Amazon overall does have a very healthy balance sheet, so no worries with this aspect of the company. We also want to let you know we have released our latest free weekly article. We drop one every single week on Monday morning to your inbox, where we discuss undervalued stocks for your attention, as well as any updates that have happened in the market over the last few days. So click on the pinned comment below, sign up, and you can read straight away. You will also be able to gain access to 36 undervalued stocks for the month of October, where we run through a lot of detail for each one, talk about the upside that Wall Street see over the next year, as well as flagging, for those that are interested, those that sit within our own portfolio. You will also be able to, for the month of October, grab 22 undervalued dividend stocks that Wall Street themselves believe have the most upside over the next year. So as we said, click on the pinned comment below, sign up, and you can read straight away. We also like to look at insider movement. Now this sits around 11%. We have just under 7 billion worth of sales over the last year. When we take a look at Q4, most recent quarter, no movement. Q3, we see around 1.22 billion worth of sales. Q2, another tranche of sales, and Q1 quite significant at 5.51. Now, in terms of looking at these individually, what we notice here is that the CEO has sold around the 21st of August. We see a more recent one, in fact, on the 24th of September, although this was for a fairly small amount, netting $400,000. Again, for transparency, information is there, although we don't necessarily believe this is a bearish signal. Management sell for many reasons, personal and financial. Now, in terms of institutions, 72.2% ownership, 23 billion worth of sales over the last year. We notice a lot more buying, in fact 3 times as much over the same period, and we can see though in Q3 for the first time institutions have sold, although marginally more than they have bought. We do however notice over the last 3 quarters, or in fact for quite some time, we have seen the opposites. Institutions have been very bullish on this company. As always though, do your own due diligence, never copy insiders or institutions, but we note overall institutions are bullish. However, the more recent quarter, we do notice more sales than buys. Now, we've already covered their top line revenue, but we want to show you here their bottom line, whether or not it follows suit. Just as a reminder, revenue growth very strong over the last 10 years. As we said, more than 6 times growth, 89 billion in 2014, 575 billion in December 2023, and on a trailing 12-month basis, we can see that growth is expected to continue. Now, bottom line, as we already wanted to flag, it does look like fairly consistent growth, although we do notice the drop in 2022, a loss of 241 million in 2014, 30.4 billion bottom line in 23, and as we can see, that bottom line net income on a trailing 12-month basis is showing a lot of those operating efficiencies, 44 billion, so we do believe December 2024 will be a great year for Amazon. Then we move on to the balance sheet, a quick health check, although we already noted it does look very healthy. Their cash, as we can see with other metrics, increasing over the longer term. 17.4 billion in December 2014, 90 billion in the latest quarter, and as we always say, one number will not tell you anything, which is why we like to compare it numerically and directionally to the total debt, which as we can see has been increasing over the period. 14 billion in 2014, 158 billion in the latest quarter, so definitely something that we would say to keep an eye on, but the net debt to EBITDA for now does look to be okay, as we saw well below the 3 maximum that we do want to note. In terms of gradings, first one, valuation, no surprises. They essentially get an F here because the PE on a forward basis at 40 sits significantly higher than the sector overall. In fact, if you're buying this company when the market opens tomorrow, you are paying a 129% premium. In fact, look at all these valuation metrics telling us the same thing. Amazon does trade at a premium. Does it deserve a premium? I would probably say yes. How much of a premium? That is what we're going to get to in our valuation. We then notice the growth grade of A-, which is good to see given it trades at a premium. In terms of year-on-year revenue growth, 12%, a lot better than the low 2% digit that we see from the sector. 11% on a forward basis, 3% in comparison, again looking very good. No surprise on why we do get that A grading here. 23.2% growth anticipated year-on-year to the EPS. As we can in fact see here, the sector median at 11% is significantly lower. Same thing, but for profitability, they get an A+. Gross profit margin better than the sector at 48 versus 37%. Bottom line as well looking better at 7 versus 4.5. And as we said, we do in turn over the next few years expect margins to improve significantly. Then we get cash from operations looking incredible, 108 billion, looking much better than the overall sector at 276. And in fact, in the Mag 7, Amazon is one of those that has the largest cash from operations. Now, before we jump into our valuation, let's quickly compare how this company has performed against others in this retail industry. We have Alibaba, Mercado Libre, some very large and well-known names. And over the last year, what we can see here is pretty much the overall sector has performed very strongly. Amazon is in the middle, around 48%. Over the last 5 years, we also note a very healthy performance, again in the middle at 115%. Over the last 10 years, one of the best, up 1,217. We do like the historical performance, but again, remember that the past performance has no indication of how they'll perform in the future. We also want to flag the comparison against the S&P. Amazon has outperformed over the last year, it's outperformed over the last 5 years, and is massively outperformed over the last 10. Do we believe this outperformance will continue? Well, if you are buying into this company, the answer has to be a big fat yes. Otherwise, why wouldn't you just consider a low-cost ETF? Now let's jump into our valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value at $226 has come from the DCF model. Now when we take a look at this, we have the free cash flow year on year. Average growth is negative. Granted, they have gone from positive to negative a few of the years, but we have gone for a growth rate moving forwards of 20%, which we do believe to be at the lower end. As we can see, we have 3 different rates. Based on 20% with the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and as we can see here, 20% upside. Now we do note these numbers are subjective and you can grab a copy of this model by clicking on the pinned comment below, but just for full transparency we will run through others. So at the 25% level we can see 319, which gives upside of 69%. At the 30% point we can in fact see $444 with upside of 135%. Now as we've already saw, their free cash flow has been growing at a very large rate, and there would be no surprises if it does continue. As we said, a lot of efficiencies are right now going through the work. However, on this channel we do want to be conservative, so at the 20% point we take it through to the next slide where we always like to use a margin of safety. We start off with 10% at the bare minimum, execute on this if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now look, if you believe that in today's episode, a buy at around $204, then we keep going till it's near the current trading price. And in today's episode, it isn't at the 20% level just yet. You are getting at least a 15% margin of safety, up to around $192. And remember, that is based forward looking on a 20% growth rate. For those that do believe, in fact, it should be much higher, then also your margin of safety would be much more. We also notice that Wall Street's price target over the next year isn't dissimilar from our intrinsic value. They see 19% upside over the next 12 months, and as we saw, they did give this a strong buy rating. So is this one you are considering? 15% MOS, 19% upside? Give us your thoughts in the comments below. Maybe it's one you're looking to buy, maybe you're holding, or in fact maybe you're selling. Do let us know. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are notified as they drop. And also don't forget to sign up to the free weekly newsletter. We are dropping our next one tomorrow morning, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.